Jeff brought this chart along. He says it's the most important chart for 2019. So why don't you explain?
Sure. So I think the chart's interesting because it puts earnings growth in an economic fundamental perspective. I think a lot of what precipitated the October weakness was this fear that earnings estimates finally started to come down and folks actually started to price in negative earnings growth next year, flat earnings growth next year. So the idea is, how realistic is that given economic fundamentals? So let's say we get to 163 in earnings for 2018. Let's say we do it again for 2019, so flat earnings. And then even give another turn lower in trailing multiples, so you get down to 15 or 14 or so. That's really where we were in the market a very short time ago. So that's what the market was pricing into a large degree. So you look at this chart and you say, okay, how overblown is that growth scare? How realistic are flat earnings for next year? And this is a chart, manufacturing PMI, graphed up against year-over-year S&P 500 earnings per share. And what you see is every time year-over-year S&P 500 earnings per share has gone negative in the past, what you've seen is an ISM manufacturing index well below 50. Now we're much closer to 60 than we are to 50. I do think you've probably seen a peak in the ISM and will probably drift lower throughout next year, but it's not consistent with contracting earnings or even flat earnings. We got Chicago PMI this morning over 65. Yeah. That has an 82% correlation with the national index. So I think it rolls over, but I think it does so.
I wonder how much of that is the market telling us something, and it never looks bad until it's bad.
Sure.
So when you start to see that roll over, the market is telling you something. When you have these conversations with clients, they're saying, what does the market see that we don't all see right now? Because everything looks rosy or blush. I think they're telling us something, and the market is telling us something 6 to 8 months out, not now.
And so it's interesting, 6 to 8 months out, maybe, but on the shorter term, you look at the Citi Economic Surprise Index, and all of those are at lows, below zero, suggesting that there's chance for an economic surprise. The economic numbers might come out better, and that could be a catalyst for a short-term bounce.
The thing is, Jeff, it's peak. It's peak. It all feels like it's peak, and the rate of change, whether it's the earnings revisions, which are negative, whether it's the basic economic data globally, it all would suggest that the market, which does look out 3, 6, 9 months, has figured out that the peak is in and that there's more downside risk. Even if it's flat, the question is, it's been all multiple compression, right, with no E. Does the E compress and somehow we're not anticipating it?